Money market funds have grown significantly in popularity in the last few years, with global assets currently sitting over $12 trillion. So in this video, I'll break down the benefits of money market funds, how they can fit into a portfolio, and most importantly, whether you should be using them right now. One of the reasons they became so popular was an increase in interest rates to combat rapidly rising inflation following the fallout from the pandemic. This followed over a decade of ultra-low interest rates, where the return on cash and cash-like equivalents was near zero. It also coincided with the Russia-Ukraine war and also a negative year for equity. Generally, when there's a lot of fear in the market, there tends to be an increase in popularity in government bonds and money market funds because they can be a great place to park cash while you wait for the equity markets to recover. Money market funds aim to provide a return that's slightly superior to that of simply holding cash while still remaining a stable and low volatile form of investing. Think of them as a great place to hold an emergency fund or to park cash before a big purchase such as a house. Say you're looking to buy a house in the next 2 years and you're currently holding your investments in equity. You may want to reduce your volatility and to preserve your capital. So you would transfer that money out of equity and hold it in something like a money market fund, where you're still going to get a fairly decent return that's likely to cover inflation, but you're not going to get the worry and volatility that comes with the equity markets. In terms of the best ones to buy, they're all going to be fairly similar, but it's really going to come down to what's available on the platform that you use. Generally, it's advisable to use one of the big names such as Vanguard, Invesco, State Street, BlackRock. This is an example for one of the biggest ones in the UK from Vanguard, the Sterling Short-Term Money Market Fund, and has £2.4 billion in assets under management. Some of the things to look out for when comparing money market funds, the first thing is the price performance, and you're not comparing the performance from one versus the other because they're generally going to be very similar. What you're really looking at is the volatility. It should look something like this, almost like a straight line. So you shouldn't see a wavy pattern. It should be very linear. The other thing to look at is the cost. They should be fairly cheap, this one being 0.12% ongoing charge. And the final thing to look at is the weighted average life for the assets in the fund. They will generally be very short, this one being 38.5 days. And actually 40% of this fund has a maturity of less than a week. Being so short term essentially reduces the possibility of large swings in price. So should you be using them right now? Naturally, we've got a lot of people talking about using them in 2026. We've got fears of an AI bubble, an overinflated stock market, global conflicts all around the world, and many expecting some form of downturn, a correction or even a crash. The problem I foresee here is that for most people, the market shouldn't dictate whether you use this type of product. It should all come down to your personal situation. Their main purpose should be to reduce volatility and risk in your portfolio, a big life event like a wedding or a house or expecting children, getting closer to retirement age where you want to preserve your capital. These are all individual circumstances that are unique to you. If you're about to retire and start drawing down your pension, it doesn't matter what the market's doing. You're going to preserve your capital and move closer to either bonds, money market funds, or even hold some cash. If you've got a wedding to pay for in the next year, again, it doesn't matter what's happening in the stock market. It may have come down 20% and you feel that's a really bad time to sell, but it doesn't matter. You've got a liability to meet. And the fear is that that could continue for another year. So you have to make that decision. But when we start making decisions to move towards something like money market funds outside of these big life events, then we are taking a more active decision in the markets. I think we all have this dream where we've seen the stock market be on a massive rally for 3 years and we want to cash out at the top. We then want to sit in the money market fund, get about 4% return for a year, watch the stock market come down 20%, and then get back into the stock market at the end of the year with a 20% discount. And it's that dream that leads investors to make these active decisions. And one of the core reasons people underperform the market is making emotional decisions. When you try to time the market like that, you've got to do it twice. You've got to know the right time to sell, but then you've also got to know the right time to get back in. Say the market does come down 20% and you've been sitting in money market funds, then great, you're a winner. You've done really well. But at the same time, you've got to know when the right time to get back in. And bear in mind, there's going to be a lot of fear in the market. It's not as easy as sitting here right now and just making a non-emotional decision because it hasn't happened yet. You've got to put yourself in that position where everyone's freaking out, everyone's worried about it doing another 20% negative the following year. Have you really got the conviction to invest that money back in at that time? And that's why this is so individual, because everyone has their own risk profile based on horizon, capacity, and tolerance. Horizon being the time to ride out that volatility or to recover from a loss. Capacity being your ability to absorb that loss or volatility. And tolerance is the emotional tolerance in able to deal with any losses or volatility that comes within that period. I also see this tends to be the first stepping stone to a number of different active decisions. You've made that active play to move your money to a money market fund. It's not really that big a deal in the grand scheme. You're still going to get a fairly decent return. It's going to just about cover inflation, but it's what it leads you to do later down the line. You've then got a decision of what to do with that money market fund when the equity markets do recover, if they do crash, but also what it leads you to do more actively within your portfolio. Whether that you might have had a simple global equity approach before, now because you're looking into the markets a little bit more, you might see emerging markets have got more potential. You may feel that real estate in a specific area has lots of potential, or that gold is going to continue in value because of global conflicts. Or maybe you want to have a little bit more safe investment and you want to pick more dividend-focused stocks. None of these on their own are necessarily bad things, but they are more active plays and having a really hands-off passive approach, which is what you may have started with before you sold and moved to a money market fund. If you're sitting on a lot of cash and you're looking for a slightly superior return, then money market funds can be very beneficial. And you're sitting on that cash because of your risk profile, and that's unique to you. That has nothing to do with what's happening with the stock market right now. Comparing the rates between what you could get on cash and a money market fund, looking at trading 2-on-2's cash ISA, you can currently get 3.6% on your cash. And if you compare that to the distribution yield on that Vanguard money market fund, which is currently sitting around 4.2%. And these rates for cash and money market funds will of course fluctuate, and they're very dependent on the Bank of England base rate. In 2025, we had 4 rate cuts, with the most recent being just last month, where it was reduced by 25 basis points down to 3.75%. And while it's not that clear what will happen in 2026, most economists are predicting 2 to 3 more rate cuts, bringing the rate down to about 3.25%. So this will of course make money market funds slightly less appealing because those rates will gradually come down, but they still remain an extremely popular product, making up 15% of mutual fund assets globally. And that increase in popularity doesn't necessarily mean there's more active plays being made by retail investors. We are living with an aging population, and with a cost of living crisis as well, there is a slightly lower risk appetite. People are prioritizing stable returns that money market funds give. I just don't want people falling into the trap or reading too much media hype, worried about a stock market crash, selling and putting their money into a lower returning asset, and then not sure what to do next. This is quite a nuanced topic, so if you want to discuss it further, then join my Discord community. It's the top link down below, and we can talk about it in more detail. Like most things in this world, the things that get the most traction and hype tends to be opinions that sit at the extremes of a spectrum. Hence, we've got people that believe the stock market's going to keep on rallying like it has done in the last few years. And then also on the other side, you've got people expecting an impending market crash. Hence, you've got more and more people totally confused and not sure what they should do. And they see it as either an option to hold 100% equity or to sell everything and simply just hold cash. But there's so much in between if you're looking to simply reduce volatility because you're worried about a correction in the stock market. And that's a perfectly normal view and feeling to have. For example, you could be in a few regional ETFs, and maybe just having a more global approach is a more passive and hands-off approach where you're not having to pick a particular region. Perhaps you're sitting in some quite high growth stocks that have seen a big rally in the last few years, and potentially you'd be better sitting in some higher dividend paying stocks, which may not get the same total return or the same potential, but they're likely to be a little bit more stable. Maybe you focus on some consumer staple stocks where if the stock market was to crash, they'll be slightly more protected because people still need to go out and buy those products. Maybe you move a small percentage of your portfolio to some government bonds between 1 and 5 years, which still get a decent return, but you get that stability. And when you do invest in government bonds for that period, they tend to be quite useful, especially in an environment where interest rates are being cut. Because price and yields move inverse to each other, the coupon that you get on a bond is fixed for the term of the bond. So even if yields reduce, that makes that coupon more valuable, and hence that price then moves inverse. Whereas simply holding cash in a bank account, you'll see that rate reduce straight away. Last month when they reduced interest rates, 6 hours later, I was getting emails notifying me that they were going to reduce the rate on my savings. So try not to follow the crowd, as easy as it is to do. Using money market funds should be very unique to you, and you have to make the decision that works best for you right now. If you are struggling to know if your reason to sell an investment is right, then watch this video here where I break it down. Hope you found that useful, and I'll catch you in the next one.